Investors are happy to see January come to a close, but they are not optimistic that the rest of the year will be any better. A look at dismal investor sentiment in this week's Fastest 4 Minutes in Finance. Hello again, I'm Scott Inman. Well, January has always been my least favorite month of the year. One of the reasons is I hate cold weather. And although we've had some mild days this winter, the Arctic blast we are under right now reminds me how little I like the season. But this year, there's been even more reason to despise January. It was a bad month for stocks. The S&P 500 was down 5.3% in the first month of 2022. That's the sharpest January decrease since 2008. And we don't ever like to draw any comparisons to that year. Investors may not think we are in that bad of shape, but they are turning sour on stock potential moving forward. The latest weekly data from the American Association of Individual Investors showed a sharp increase in the percentage of individual investors who are bearish about short-term market expectations. A slim majority of 52.9% represents the second most bears of the past 10 years and the highest level since April 2013. It's all happened rather quickly, too. The spread between bulls and bears fell to negative 29.8%, a rapid decline from the first of the year when bulls outnumbered the bears. Some of investor sentiment is no doubt being driven by the market drops during the month. But the real fears behind the trading woes are contributors as well. Markets are still worried about the major Federal Reserve moves expected throughout the year as the Fed considers multiple interest rate hikes and quantitative tightening. Inflation is still expected to be high for at least the first half of the year as supply chain issues persist, and more recently, geopolitical tension over Russia and Ukraine. However, extremes in negative sentiment tend, on average, to be bullish for future returns in the near term. According to a chart from LPL Research, the spread between bulls and bears has only been this wide 3% of the time since 1987. But in those conditions, the average returns on the S&P 500 have been positive 3 months later, 6 months later, 1 year later, 2 years later, and even 5 years later. In fact, the only time future returns have been negative has been when investors have been extremely bullish. So just because investors are pessimistic doesn't mean they have reason to be. In fact, recent history shows us as we turn the calendar, there's reason to be optimistic for the rest of the year. According to another chart from LPL Research, 9 of the past 10 times that January was negative, the next 11 months were positive. Using LPL Research as our guide, the market correction in January and extreme pessimism of investors are not significant indicators that we are entering a prolonged bear market. The economic environment is still strong, and the Federal Reserve appears to be making proper and expected policy moves. While there are always risks, the outlook for the market to begin moving in the right direction soon is good. Now, if we can just get the temperatures to turn around too, things will really be headed in the right direction. Thanks for watching.